kicking us off to the close today. And let's start off with that jobs report, Stephanie, and how much we should read into the potential for a miss on those numbers we just had on the screen.
Yeah, I think, when we look at what the Fed is paying attention to, it's certainly going to be the jobs report, and it's certainly going to be, where that trends. So I don't think we can overemphasize it. I think right now the Fed is going to continue to be data dependent as they have been. However, the data shifted, as we've all seen, from inflation to now, employment numbers. And so we do think that tomorrow's jobs report will be a key factor in determining forward-looking guidance from the Fed.
When you look at the data that we've gotten so far, and if you look at some of the estimates for what we might get tomorrow, Stephanie, does it feel like yields right now in the Treasury space are priced appropriately for the amount of rate cuts that we might get?
It feels like we're a little bit more aggressive than we need to be right now in the Treasury market. Here, our economists are calling for 2 more rate cuts, about 4 next year. We're actually calling for about 1 rate cut every other meeting for next year. So we do think that unless something changes significantly, we are likely to stay on that path. I think the market is calling for much more aggressive forms of cuts, which we don't think we'll get to.
It's not so long ago that we had a growth scare. August 5th was not so long ago. Early September also not so long ago. What could that growth scare come in the form as? What might that look like if we do get one?
So I think right now we're in a space where, when it comes to data and what we're seeing come out of the economy, everything is going to be a potential for a scare. I think that everyone is very, very hyper focused on all of the economic data that's coming out. And so, I think something that traditionally may not be a scare right now in this environment could be a scare because the market is really just looking for any cracks in the facade that it can find.
Talk a little bit about demand for Treasuries as a safe haven versus, say, gold or anything else. I mean, we know that oil prices have been getting a lift because of fears of disruption to oil supplies, but Treasuries have certainly gotten a bid in the wake of the conflict in the Middle East, the renewed conflict.
Yeah, so we do think that, the flight to quality is something that typically does take place. We think that there has been some volatility, in the commodities markets. And right now, it seems like, again, we're going to see a shift back to Treasuries as that safe haven asset class if we do continue to see a lot of these geopolitical macro risks in the system.
So when we get to this idea of where we end the year and the idea that everyone's already sort of priced in much more aggressive targets for year-end market performance, and for that matter, to a certain degree, slightly more aggressive targets heading into 2025. Are you in a position, Stephanie, you and your team over there at Invesco, to start sort of going out on that limb for 2025, or do you want to wait to see just what we learned from the Fed in November and beyond?
I think you have to be prudent in this environment, right? So we're looking at all of the credit fundamentals. We're looking at the underlying idiosyncrasies in various parts of the market. But you have to pay attention to what's taking place and what the rhetoric is that's coming out of the Fed. So while I think, all of the data points we're looking at make us feel good, we think, the market is primed for investment. The market is primed for investors looking out, getting away from those Treasury bills and now looking at the intermediate part of the curve, low default rates, strong yields. But we would be remiss if we didn't pay attention to what the Fed is doing as well.
How many people, though, I mean, and particularly I'm talking about your clients, are really willing to sort of, I guess, let go of that 4 or 5, maybe even some cases close to 6% on the short end, extend duration now? Because you're still seeing, at least in money markets, you're still seeing record levels there. And even in other parts of the shorter end of the curve, based on CFTC data, you're still seeing a lot of people crowded there.
We are still seeing quite a bit of investment in that front part of the curve in Treasury bills and money market funds. But we are starting to see record inflows into intermediate funds, the 3 to 10 year part of the curve. You look at the long end of the muni market. The muni market's gotten now 38 trading days, I should say, of consecutive inflows into that part of the market. So we are seeing a lot of investors that have had some pent up demand sitting in cash and don't want to pay the opportunity cost if they stay too long.
Okay, so we're seeing that demand for short-term debt in Treasuries, in munis. What about for corporate credit? Where do you want to be? How do you want to be positioned given where the economy stands right now?
Yeah, we think that right now is a time where we actually believe that the tail risk, that the Fed is sort of taking some of the tail risks out of the equation. And with that, we think high beta strategies are the way to go. So, when we look at the corporate space, we do like, down in quality. We do like the high yield portion of the market. We've got an active ETF, GTO, that is taking advantage of some of that right now.